What's going on, guys? Welcome back to the channel. In this video here, we're going to be investigating HP. Probably heard the news. Warren Buffett has taken a massive stake in this business, 11% of the company, evaluated at $4.2 billion. He is not messing around, folks. When Warren Buffett makes a move, he is making waves. So we're going to dig into this company here. We're going to load it up into our stock research tool and determine whether this truly is a value play and try to get into the mind of Warren Buffett and try to see what he sees in this business. So without further ado, let's load up HP and see what we're dealing with. So we're going to load it up. Here's the stock research tool here, and we're going to go through our three categories. If you're new here, we're going to look at the company metrics category first. And in this category, what I like to do is compare the 5-year average numbers to our trailing 12 months numbers. And what I want to see ultimately, has the company been improving over the last 5 years, ideally, or are they decreasing? Like, where's the company going? So right off the bat here, let's go through these first four categories with our PE trailing 12 months sitting at 6.64, extremely low, which is very attractive. And our 5-year average PE is at 9.66, also very low. Something very rare to see within a tech company. And at a $36 billion business, it's not a small company, folks. So this is something that's somewhat strange, not strange to see per se, but it's uncommon. EPS is up over our 5-year average. Return on equity looks absolutely horrible. So we'll have to look into that and see what the story is there. And we're up on our profit margin compared to our 5-year average. Compared to from 10, we're up compared to our 6.92 5-year average. So with the exception of our return on equity, there's some improvement here with HP looking pretty good so far, chugging away. Revenue is at $64 billion, net income is at 6.52, free cash flow is $6.32 billion, and we're up over our 5-year average at being 4.2 billion. That's really great. $2 billion higher than our 5-year average. That's phenomenal to see. We pay out a small dividend at 2.2%. And folks, remember, dividends are not always secure. So we have to ensure that they can pay out those dividends. And with $938 million being allocated from our free cash flow and our average free cash flow being $4.2 billion, that is easily covered. Not a problem whatsoever. Our return on invested capital, folks. Now, I thought the free cash flow was very impressive. Check these numbers out. 61.29% on our return on invested capital trailing 12 months compared to 44% on the 5-year average. Guys, these are probably the highest numbers I've seen thus far in my whole history of making these videos. So the fact that they're this high, it screams to me that they know how to invest their money, which is great. We want a business that can do that. Allman Z-score sitting at 2.71. We want this ideally over 3. That just means that they're in a gray zone in terms of bankruptcy, but I mean, they're on the positive side. They're close to 3. Pietrowski score is sitting at a 7, a decent score. Ideally, we want this between 7 and 9, 9 being the highest score you could possibly get. So 7 would suffice. So right off the bat, my initial thoughts on HP is that they're making tons of improvement. Their free cash flows has been improved over the last 5 years. They can cover a dividend. Their PE ratio is going down. So I'm wondering where that stands with their revenue, if their revenue is increasing or not. EPS is also increased. So I mean, I'm very impressed. We have a higher earnings per share, lower PE ratio. I wonder what the catch is with this business, because every business has a catch. But overall, very impressed. There's a return on equity. We'll have to look into that, but that's somewhat concerning. Let's jump over to our financial evaluations category. And now here is where we'll give the stock a score out of 10. And we're grading this company an 8. We're only losing 2 points in two, well, somewhat key categories here, folks. Our current ratio is sitting at 0.74. Now, ideally, we want this number to be over 1.5 because that will indicate to us that they have enough assets on hand to cover their liabilities. And the return on equity average is, as we expressed, negative 338%. So that is terrible. So we're losing points there. However, to offset that, we are earning points in a lot of key categories, if not the best categories. These are the categories I can definitely get behind. Our 5-year PE average is 9.66. Our EPS growth is up. Our return on our debt to equity. Now, here's the thing: debt to equity, when sitting at a negative number, like, what does that even mean? Like, I've seen numbers below, like, close to zero, but like, what does that even mean? I wonder if there's like some sort of write-off or something that I gotta look into that. I've never seen a negative number. I've never seen a negative number on any company thus far. Ideally, we want this number to be below 50% because that would indicate to us that the company's building or growing the company through equity and not through debt. So this negative number is somewhat confusing considering we don't have a lot of assets on hand to cover our liabilities. So I have to look deep into that. But that's what was reported. So something to keep in mind. Our share dilution, we are buying back shares. A negative 16% of shares have been bought back. So they're decreasing dilution over the last 5 years, which is great. And that means you as a shareholder are owning more of the business, and that's what we want. Assuming the company is undervalued, that is a major, major plus. 5-year net income growth is up. Free cash flow growth is up. Revenue growth is up. Now, revenue growth is somewhat lagging behind at 5.84%. That is slight. That is some slow growth. However, it's growth nonetheless. And obviously, as I expressed before, our 5-year return on invested capital average is incredibly high. We want this number to be over 10% or 10% or higher, and we have that. So for me, these categories all over here with the share dilution, all these where it's all green, these are the categories that are the heavy hitters. Are we buying back shares? Are we growing the revenue? Are we growing the free cash flow and the net income? Because this is how the business is going to progress forward. And the return on invested capital, that is a healthy bonus. It is the cherry on top of all of this. So I'm beginning to see why Warren Buffett has put a huge stake in this business. They know how to make money on their capital that's been being invested. The business is growing, even though it is somewhat slow. It is growing nonetheless. Free cash flow, he's a huge fan of that, as am I, and that is ultimately growing as well. So, and they're buying back shares. Like, guys, it's here. It's written on the wall of why he has a huge stake in this business. But without further ado, we're going to jump into finally a price analysis, and we're going to try to gauge what is a fair value for this business. Now, our current price right now is sitting at $40. Now, granted, it definitely jumped up in the last, little bit because, today it jumped up because of Warren Buffett's purchase. We're gonna do a price analysis. We'll jump into this bottom category here. Folks, if you're enjoying the video so far, please consider subscribing. It helps out the channel a lot and makes me feel warm and fuzzy inside. Now, the software that I have in front of me will be an app, so stay tuned for that. And this is something that you can definitely use to analyze stocks of your choice, and you don't have to wait for me to make any kind of videos. So stay tuned for that. That will be available. If you're interested, send me a message down below. There's my email in the description box below. That's invicticamedia@gmail.com. So we're going to jump into the price analysis here and take a look at what we can do. So we're going to do 3 evaluations looking at a 10-year outlook. Ultimately, we're going to be conservative on these estimates. Major jump in the 1 year. Major jump in the 1 year. Very interesting. Let's go for 4.5 and 5. Oop, not 85. 5. We're going to stay somewhat within that those 1 year numbers. You know what I'm going to do, folks? I'm going to just fill these out real quick. I'll get back to you in just a quick second, and then I'll discuss why I did what I did. Give me one moment. So what we did here was we stayed conservative on the revenue growth because I have to. Because if we're looking at the 5-year average, we're sitting at 5.84. Now, with our 1 year, it jumped up 12%. Now, that is somewhat inconsistent. Now, if I just jump, looking at the revenue here, I mean, the proof is in the pudding, folks. We're jumping. It's it's increasing. We've had some dips in revenue, but it's going up nonetheless. So ultimately, we want to be conservative as possible. So what we're going to do is go with the 4, 4.5, and 5. Now, profit margin, we're also going to hover around that 5-year range with not crossing 6, because we want to hit numbers, or we want to put numbers in here that we know we can potentially hit, right? If we hit 10 on 1 year and we've hit 6 on 5-year and 4 on the 10-year, so we can possibly hit 6 at the high end, 5 at the low end, no problem. So 5-year free cash flow margin, same thing. We're going to follow that same principle. Now with the price of free cash flow, we're going to put this at 6, 8, and 10. Any number between 20 would make sense, but considering we're at such a low multiple here, 6.5, 6, 8 would probably be suffice to cover those two metrics, and then 10 on the high side. PE ratio, same reasoning. We're sitting at 6, but our average PE is 9.66. So ultimately, I'm going to go 6 to cover the low end, 8 to cover our median, and 10 to cover our high end. Now we're going to put a desired return of 13%. Now, check it out, folks. We're currently sitting at $40 a share price. Now, our average calculation came out to $39.86, pretty much on par with what we're currently at, being at fair value. Now, what we are getting is at $47 on the low end for our discounted cash flow formula, $59 on our moderate, and then aggressive, we're at $66. So I believe Warren bought it around 33 to 35-ish. So if that's the case, that would put us definitely in the undervalued category, minus the jump that we had today. So it's based off just this price analysis and these low assumption numbers. Like this, look, guys, this is considering just 4% revenue growth. Now we're not getting those price to free cash flow numbers because we are using somewhat of a low number. I never really go this low, but based off these revenue growth numbers, this is quite impressive. Like this is assuming extremely low numbers, 4, 4.5, and 5, with a discount on profit margin. I can see it. I'm hoping you can see it too. Like I'm being ultra conservative on these estimates, and I guarantee you folks, he ultimately did the same thing. And the price that he bought it at would make total amount of sense. He's buying it. Let's say hypothetically it hit the aggressive category at 5% revenue growth, and we had it at $66 as our fair value there, or to make a 13% return. He bought it at half that, so that's a 50% margin of safety based off of that analysis. To me, it's clear as day why Warren Buffett is buying this business. They're hitting all the right metrics. Now, the only thing that's somewhat concerning is that they are growing their revenue slow. However, Warren, he is one to buy, I would say, boring businesses per se. This is my at least assessment of, I mean, minus Apple. Apple's probably the most exciting business he has in his portfolio. However, HP is one of those businesses that I don't think anyone ever talks about anymore. Like they used to be an incredible tech company. I mean, maybe not incredible, but up there. They used to be everywhere. They're a well-known brand, but I feel like personally, from the technology perspective, they've fallen off. However, there's still value within this business. Now, would I go out and buy HP today because Warren Buffett bought it? Absolutely not. I'm going to have to do my own due diligence and dig deep into this company, because if I'm going to look at the, absolute best of the best tech companies, HP would definitely not come to mind. However, there are some keys here that obviously Warren sees, and I'm beginning to see them too, of okay, well, this business has great cash flow, great return on invested capital. So these fundamentals are still there. It's whether or not, how relevant will this business be in 10 years rather than how well it's going to perform. Because listen, in the technology sector, and I just put out a video on IBM, you can check it out right over here, and why that company is absolutely terrible and why you should potentially avoid it, is because with technology companies, if they fail to innovate, they fall off a cliff. essentially. And I had to dig deeper into HP and really see, is this a business that is on the verge of doing that? Personally, I don't think so. However, this is where the due diligence comes in, because you got to dig deep. But from a financial perspective, it makes sense based off what I've shown you here. Anyways, guys, that's the video. What are your thoughts on HP? Leave a comment down below. And what are your thoughts on Warren Buffett's massive stake in this business? 11% is huge. It's a big stake. So write it down here in the comments. Let me know what companies you want to see evaluated, and I'll see you in the next video. Thank you so much for watching. Until next time.